Good day, ABM Business Finance learners. Once again, I am Yang and welcome to my class. In this video lesson, we will tackle about financial system. Before we proceed, let us review first what we have tackled in our last video lesson. In our previous lesson, we have discussed the three financial management decisions of the CFO, and these are the operating decisions, financing decisions, and investing decisions. Let us also review the finance division organizational chart, which is headed by the CFO, or the Chief Finance Officer, also called as Vice President of Finance, and the two departments created under the CFO is the Accounting Department and the Treasury Department. Accounting Department headed by the Chief Accountant, and the Treasury Department is headed by a Treasurer. Under a Chief Accountant, we have Tax Manager, we have Financial Accounting Manager, we have Cost Accounting Manager, and Data Processing Manager. And under Treasurer, we have Cash and Credit Manager. Also, we have Cash Expenditures and Financial Planning Managers. Since you are done with our short review, let me present first the most essential learning competency in this video lesson. The most essential learning competency is you can distinguish a financial institution from financial instrument and financial market. Let me present two scenarios for us to have a glimpse of our lesson. Okay, suppose you are at two entities, the saver and the borrower. If saver knows that borrower is in need of funds, or if borrower knows that saver is willing to invest funds, saver and borrower may agree to make a private placement or an agreement. This scenario is called direct financing. The saver and the borrower are present at the same place and at the same time. However, if these facts are unknown to them, saver and borrower can go to a financial market, which is an organized forum that lets saver along with other suppliers of funds and borrower along with other user of funds meet and make transactions. Once saver and borrower have met in the financial market will meddle them to make a private placement. There is no standard structure of a financial system that operates in the world. It varies among countries and among business organizations. But this figure that I will show you will illustrate the structure of a financial system, of a typical financial system rather. This system is responsible for the channeling of funds from the savings of the savers, lenders, cash surplus, which can be happen as an individual, household, businesses, or corporation, to the borrowers like individual, household, businesses, or corporations that needs funding through the support through financial institutions, financial markets, and financial instruments. The basic elements of a financial system are as follows: the financial market, the financial institutions, the financial instruments, and the lenders and borrowers. Let me present first the financial market. Financial market. It is a place where the selling and buying activity occurs to trade equity securities like bonds, stocks, currencies, derivative securities, notes, and mortgages. The selling buying transaction happening in financial market is called trading activity. The types of financial markets are capital market, money market, primary market, secondary market, and public market. Let us discuss first the first type of financial market, which is the capital market. Capital market is a financial market where stocks and bonds are issued for medium and long-term periods. Stocks are treated as equity securities, while bonds are technically considered debt securities. Investors who hold stocks receive return from their investments in the form of dividends, while those who hold bonds earn income in the form of interest. The capital stock market treats the securities having a period of 3 to 5 years as medium term and those having a period of more than 5 years as long-term equities. Long-term securities rather. Large financial transactions happen in the capital market. The volumes of trading can reach millions every day, while the amount involved can be up to billions of pesos for one trading period. In the Philippines, the capital market is the Philippine Stock Exchange. The second type is the money market. The financial market is classified as money market when the financial securities being traded have a period of less than 1 year. This type of financial security is called short-term security. Since short-term securities are not intended to be held for more than 1 year, they are also referred to as trading securities. In addition to short-term stocks and bonds, money market also trades commercial papers and treasury bills. Commercial papers and treasury bills have a maturity period of less than 1 year. The money market therefore trades financial securities that are highly liquid or readily marketable. The term highly liquid or readily marketable implies that there are available sellers and buyers of the financial securities. The Philippine Stock Exchange is both a capital market and a money market. The third one is the primary market. The primary market is a financial market where a corporation can issue new shares of stock. Stock corporations that need fresh capital can raise the required funds by issuing new shares of stock. The primary market facilitates the raising of the required amount when the investors directly buy the new shares from the issuing corporation. Therefore, the trading of financial securities in the primary market happens between the issuing corporation and the investors. The proceeds of the trading go to the issuing corporation. The next one is the secondary market. The secondary market is a financial market where financial securities are traded between or among investors. In the secondary market, there is no issuance of new shares from the corporation. The secondary market exists after the corporation has issued new shares to the investors in the primary market. The issuing corporation is no longer involved in the secondary market. Hence, the proceeds of the trading in the secondary market go to the seller of the securities. And the last is the public market. A public market is a market in which the financial securities of publicly listed corporations are traded following a standardized contract agreement and procedures. A corporation is classified as publicly listed when its shares are available for sale to the public. Basically, a public market is an organized financial market. Trading in the public market immediately starts during the day once the market has been officially opened. Investors are properly informed at any point during the trading time of the current price of the stocks and bonds and other related information necessary in the trading. The next element of the financial system is financial institutions. Financial institutions are institutions or organizations that provide financial services, among others, in the form of loan, credit, fund administration, financing, depository, and safekeeping. Financial institutions, based on the financial services provided, are generally classified as follows. First, depository institutions. Second, financial intermediaries. And third is investment institutions. Depository institutions are financial institutions that accept deposits such as savings, current, and time deposits from individuals and corporate entities, extend loans to borrowers, transfer funds, and manage funds for investment purposes. Depository institutions include the following. The first is the bank. Banks are institutions that accept deposits and bills payment, provide loans, and facilitate the transfer of funds domestically or abroad. Next is savings and loan association, sometimes referred to as a financing and a mortgage loan company. It is engaged in a business of accumulating the savings of its members and stockholders and using such accumulations for loans or investment in securities of productive enterprises. Next is trust company. Trust company is a legal business entity, usually a major division of a universal or commercial bank that acts as a fiduciary agent or trustee on behalf of an individual person or corporate entity for the purpose of management, administration, and final transfer of property to the beneficiary. And last is the credit unions. A credit union is a financial depository institution that is mainly controlled and operated by its members for the following purposes: extending credit to members, offering competitive interest rates, promoting the concept of thrift, providing other types of financial services. Credit unions exist to help and extend financial assistance to members by pooling and accumulating funds from all the members. Next is the financial intermediaries. Financial intermediary is a type of financial institution that acts as a middle person between two parties, such as the investors and the borrowers. Financial intermediaries raise and accumulate money from investors and offer the accumulated money to individuals or corporate entities in need of financial assistance. The financial intermediaries are the following. First, the mutual funds. Mutual funds accumulate money by selling shares of stock or bonds of publicly listed corporations to individuals or corporate investors. The funds from the proceeds of the sale are pooled together and channeled to the borrowers. Second is a pension fund. A pension fund is set up by a business for the purpose of paying the pension requirements of all private sector employees who retire from the business organization upon reaching their retirement age. And last is the insurance company. Insurance company acts as a financial intermediary by pooling together the proceeds of insurance policies sold to the public and investing the accumulated funds in a high-yield maturing securities from investment houses. Most of the money accumulated by insurance companies from insurance premiums is lent in either medium or long-term loan to companies engaged in a commercial real estate. Insurance companies may offer the following products to the public: life insurance, health insurance, car insurance, fire insurance, crop insurance, marine insurance, and other insurance products. And the last type of financial institution is an investment institutions. An investment institution is a company engaged in buying securities of other companies which are listed in the stock exchange for investment purposes only. Hence, the buying and selling of financial securities are not the primary business activities of an investment institution. In other words, an investment institution or company simply holds on to the securities it acquired from other companies. Financial securities are held up to the time of their maturity. The financial institution earns income from holding the securities in the form of interest or dividends. This diagram shows how financial institutions provide financing for the firm. The individual investor deposits their money to commercial banks and other depository institutions, or they can purchase shares of stock from a mutual funds. Also, the policyholder pays premium to an insurance company, and the employees and employers pays their contributions to a pension funds company. And these financial institutions provide direct loans or purchase of debt securities or equity securities from the firm. So the firm also provide income to these financial institutions and eventually return that interest to the individual investors, policyholders, and employees and employers. The third element in the financial system is the financial instrument. Without it, financial institutions and financial markets can hardly exist. The financial institutions and financial markets carry out their activities through the financial instruments. The financial instruments refer to the contracts that give rise to the formation of financial assets of one entity and at the same time the creation of a financial liability or an equity instrument in another entity. In all financial instruments, two parties are involved. One party has the contractual right to receive the financial assets, and the other party has the contractual obligations to pay or deliver the financial assets. The common forms of financial instruments are cash, check, loan, bond, and stock. Cash. On the part of the holder, cash is a financial asset. However, on the part of the government, such as the Bangko Sentral ng Pilipinas, cash is a financial liability. Second, check. Check, it is a financial asset of the payee, but is considered a financial liability of the drawer or issuer. Loan, it is a financial asset of the lender or creditor, and a financial liability of the borrower or the debtor. Next, bond. Bond is a financial asset of the holder or investor but considered a financial liability of the issuing company. Last is stock. It is a financial asset of the investor or shareholder but an equity of the issuing company. The last element in the financial system is the lenders and borrowers. The ultimate lenders lend to borrowers either directly or indirectly via financial institutions by buying the securities they issue. The lenders are the surplus economic units, while the borrowers are the deficit economic units. Who are they? Lenders and borrowers can be a household or individuals, a corporate or business sector, a government sector, and a foreign sector. The members of the four sectors are either lenders or borrowers or both at the same time. Thank you and have a nice day.